If you ever wondered about turning your hard-earned money into a wealth-building powerhouse, you're in the right place. Investing in stocks isn't just for the Gordon Geckos of the world. It's a financial adventure that anyone with a bit of curiosity and the willingness to learn may set across. But before we tell you about how to invest in stocks, make sure to subscribe to our channel and press the bell icon to get regular updates. Let's get started. Number 1. Decide how you want to invest in the stock market. Your investment strategy should align with your time horizon, risk tolerance, and financial goals when you make your initial entry into the stock market. Some people are addicted to the rush of trading stocks, making calculated purchases and sales in brief intervals of time. Long-term investment requires investors with a patient mindset to deal with market swings over protracted periods of time. By concentrating on stocks that consistently pay out dividends, dividend investing provides a reliable source of income. Index fund investing provides instant diversification by tracking a market index, while robo-advisors automate portfolio management based on your financial goals. In the event that you choose a more detached approach, robo-advisors come into play, combining automation and customized financial planning techniques. Number 2. Choose an investing account. Selecting the appropriate investment account is crucial when it comes to investing. One option is the individual brokerage account. Similar to a standard account, you can purchase and sell stocks as well as other items using it. This one gives you a lot of control. Retirement accounts are another option. These are long-term investments that can assist you in retirement savings. The first is the self-managed IRA, and the second is the employer-sponsored 400 and only. You can receive some wonderful tax benefits from these accounts. For those who are saving for college costs, there is the 529 plan. If you spend your money for educational purposes, it helps it grow tax-free. If you want to further your education, this is a wise decision. To make things really simple, robo-advisor accounts are available. These are like having a robot friend who manages your money for you. They curate and manage a variety of investments dependent on your preferences and your tolerance for risk. The margin account is available if you're feeling a little more daring and would like to borrow money to invest. You can do that with this one, but it's not as safe. Number 3. Learn the difference between investing in stocks and funds. When you invest in individual stocks, you're buying shares of a specific company. You become a partial owner of that company and your returns depend on how well that company performs. It's a more hands-on approach, and success is tied to the individual fortunes of the companies you choose. This method requires research and a good understanding of the companies you're investing in. On the other hand, investing in funds involves pooling money with other investors to buy a diversified portfolio of stocks, bonds, or other assets. There are different types of funds, such as mutual funds, index funds, and exchange-traded funds, ETFs. Funds spread your investment across multiple assets, reducing the risk associated with putting all your money into one company. It's a more diversified and often less hands-on approach compared to picking individual stocks. The key difference boils down to the level of involvement and risk. Investing in individual stocks can be riskier, but it also provides the potential for higher returns if the companies you choose perform well. Investing in funds is generally considered a more conservative approach, offering diversification to mitigate risk, but with potentially lower returns compared to a successful stock pick. Number 4. Set a budget for your stock market investment. Establishing a budget for your stock market investment is a crucial step to ensure financial stability and prudent decision-making. Start by evaluating your current financial situation, including your income, expenses, and any outstanding debts. Determine how much money you can comfortably allocate to investing without jeopardizing your essential needs and emergency fund. Consider your investment goals and time horizon. If you're saving for a short-term goal, like a vacation or a down payment on a house, your investment strategy may differ from a long-term retirement plan. Longer time horizons generally allow for a more aggressive investment approach, while shorter ones may require a more conservative strategy to safeguard your capital. It's essential to be realistic about potential returns and the inherent risks of the stock market. Markets can be unpredictable and values can fluctuate. Avoid investing money that you might need in the short term or cannot afford to lose. Number 5. Focus on investing for the long term. When you focus on the long term, you're not just reacting to short-term market fluctuations, but rather you're positioning yourself to benefit from the overall growth of the market over time. One of the key advantages of long-term investing is the power of compounding. Over the years, your investment returns have the potential to generate additional earnings. And these earnings, in turn, can also earn returns. It's like a financial snowball effect that becomes more potent the longer it rolls. Long-term investing allows you to ride out the inevitable ups and downs of the market. Markets can be unpredictable in the short term, but historically, they have shown an upward trend over longer periods. Moreover, focusing on the long term minimizes the impact of market noise and daily fluctuations. It encourages a disciplined and less emotional investment strategy. Rather than being swayed by the latest headlines or short-term market movements, you can make decisions based on a thorough understanding of your financial goals and a confidence in the resilience of the market over time. Number 6. Manage your stock portfolio. Managing your stock portfolio is like tending to a garden. It needs attention and care to flourish. One important rule is to spread your investments around, kind of like not putting all your eggs in one basket. This is called diversification and helps lower the risk of your portfolio taking a big hit from one bad-performing investment. Regular checkups on your portfolio are a good idea. Make sure it still matches up with your goals and how comfortable you are with risk. If something's out of whack, consider adjusting your investments to get things back in balance. Stay in the loop with what's happening in the financial world. Keep an eye on the companies you've invested in and what's going on in the market. Being informed helps you make smarter decisions. Think long-term. The stock market can be a bit like a roller coaster, lots of ups and downs. But if you focus on the big picture and believe in the strength of your investments, those short-term bumps are easier to ride out. Know how much risk you're okay with and stick to it. Don't let short-term market swings push you into making snap decisions. You can even set up safety nets, like stop-loss orders for individual stocks, to limit potential losses. Number 7. Learn to diversify and reduce risk. Learning to diversify and reduce risk is a smart strategy when it comes to investing. Imagine your investments as a basket of different fruits. If one fruit goes bad, you still have others that are good to eat. That's diversification, spreading your investments across different types of assets to protect yourself from the ups and downs of the market. By putting your money into a mix of stocks, bonds, and maybe other types of investments, you're not putting all your financial eggs in one basket. If one investment doesn't do well, the others might balance it out. It's like having a safety net for your money. Reducing risk is not about avoiding all risks but managing them. Think about it like driving a car. You can't eliminate the risk of a flat tire, but regular maintenance and having a spare tire in the trunk reduce the impact when it happens. I hope you found the video enjoyable and informative. If you did, please show your support by giving it a thumbs up. Remember to subscribe to our channel and enable the notification bell to receive more valuable content like this in the future. Thank you for watching.